Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we have a special guest. I've dragged back Stephen Cush from Shore Financial. Stephen is a senior credit advisor. Pretty fancy name, mate, for mortgage broker.
Fancy name for a mortgage broker. That's right.
That's it. I thought get Steve back on to give us a bit of a update on what's been happening in the lending market when it comes to loans, getting loans. How are you, mate? How's
Well, things are good. Business is good. Busy. How's things with you?
doing well? Starting to pick up now. I can feel it in the market. So I thought it would be good to get a bit of an understanding from your perspective of what's happening in the lending market. What's just to kick it off, what's your, I guess, view on the lending landscape since we've received that rate cut in February?
Um, I mean, not a great deal has changed, to be honest. I guess, tangibly speaking, um, you've seen a slight increase to people's borrowing capacities because you've got lower interest rates, which means people can borrow slightly more. I would say that's about a 2 to 3% increase, which doesn't sound like a lot, but look, if you try and borrow $1 million and you can borrow an extra 20 or $30,000, that might be the difference between you being the winner at auction or not. So look, relatively small change in that sense, but I'd say, look, anecdotally speaking, obviously we don't have the results yet, but what I've said, I've for a long time been carrying a lot of clients who are pre-approved for a long time, who haven't been able to buy. They missed out in the spring buying season of last year. I've never had so many clients pre-approved for so long. And in the what is it, about 5 or 6 weeks since we had that rate cut with the RBA, I've seen a lot of people transact and actually go ahead and buy something. That could just be my small little slice of the universe just happening in my world, but I've sort of seen it across a lot of the brokers at Shore Financial as well. So maybe that was that little bit of confidence boost catalyst for a lot of people to really just go and buy something. Um, but yeah, that's I guess that's what I've seen. Nothing too dramatic, but that could just be more of a case of timing,
Yeah,
personally, with
I feel I feel it's a
clients buying.
bit of a sentiment shift.
Yeah,
Would you say? I mean, we've had about, I guess, over the last couple of months, over 100 inquiries, and people are sitting on the fence, sorting out finance, sorting out this, sorting out that. But really, in the last since Feb, people are now starting to pull the trigger, and not so much, I guess, cautious. I'd say it's all right. We need to go. We've got pre-approval. I think it's a sentiment shift more than anything that maybe people are seeing this may be it in terms of the rate
that's
hiking
it.
session and
That's the important piece there. The
yeah,
the sentiment, it's just like with buying real estate. People don't want to feel like they're going to buy something and then it's going to be worth less in 6 months. Same with taking on a loan. They don't want to take on a loan, like commit to something, big commitment like that, and then the rates of 6.5%, 7%, like they go up. So with the first rate cut, there is the expectation or that we have hit that peak of the rate cycle, and that if anything, we're going to see some more rate cuts, hopefully this year. I mean, I'm pretty sick and tired of all the speculation with rate cuts, when they're coming, when it's happening. A lot of commentary around it, but I think there is that good positive sentiment that we have reached the ceiling and we are on the way back down. So yeah, that's the key piece, I think.
and are all the banks passing it on? I saw you guys flicked around a bit of a snapshot of what the banks are doing, but are you able to give us a bit of a feel for what the banks are doing?
Yeah, that's interesting. So look, firstly, yes, they have passed on the rate cut and in full. The only bank I have heard of who has not passed it on was Virgin Money. Personally, I haven't really done any loans with them for my clients. So that didn't affect myself personally, but yeah, every lender that I know of, any lender worth their salt, has passed on that rate cut in full. What I would say that is interesting is any new to bank loans. So say you were pre-approved and you had a pre-approval and your loan and your rate was 6% on that pre-approval, and you're still pre-approved. You're pre-approved pre-rate cut and now post-rate cut. You'd think your pre-approved loan of 6% would go down to 5.75, but that's not really the case. The 0.25% cut was for existing loans, so loans that are already established. So now if you go for a new loan with one of the big banks, often if the best rates were about 6% a month and a half ago, now the best rates are around about 5.79, 5.89. So yes, they've passed on the 0.25 cut, but they've dialed back the discounts that they're offering. So they're not offering as big a discount off the standard variable rate.
Right.
So it's a little bit, I won't say it's sneaky, but the banks are retaining a little bit of margin on new to bank lending at the moment. Because people who were seeing rates 6% above, yeah, okay, they can get 5.79, 84, 5.89 now. It still sounds a lot better than 6%, but it's not the full 0.25 off. So that's just something to be aware of. And of course, there are always good deals floating around at the top of market. You can get down to 5.69 potentially, or even lower, depending on the bank. But yeah, that's something I've seen.
So just
Also,
on that with the banks, yep. You got.
Also important to note that, yeah, like people with existing loans, your rate went down doesn't necessarily mean your repayments go down. Some lenders pass on the cut and lower your repayments. Some lenders pass on the cut but leave your repayments as they are. And their way of thinking is it's good for you to keep making repayments at a certain level. It means you'll pay off the loan sooner, build equity. So that's kind of split down the middle, the way banks treat that. But again, something for you for the punters to be aware of, that your repayments, even though your rate went down, your repayments might not necessarily automatically go down.
So then, just as a broad view across the big four and the non-bank lenders, what rates are you seeing currently with the big four banks? And
owner-occupier rates, variable, principal and interest, I would say generally in the range of 5.69 to 5.89 is competitive. Anything less than 5.79 is very competitive. It's top of market at the moment. Investor rates, yes, you can get a loan sub 6% now as an investor. I know ING is very good at the moment. I think we can get them down to 5.94 or 5.89. So there are rates for investors sub 6%, but most of them would be around the low sixes.
Okay, so if people have been sitting on the sidelines and their pre-approvals have lapsed, can they expect a little bit more borrowing capacity now?
Yeah, absolutely. They should. Yeah. So if it was something,
2%
they
or 2 or 3%?
could rely, about the extra 2%. Look, it varies from case to case, but yeah, definitely there's an increase.
Cool. So another thing, coming into end of financial year now, I guess I always have to do this, but some strategies around debt or ATO debt solutions that you have. Is this something what the banks are pushing? Because I mean, wanting people and businesses to pay off their ATO debt.
Yeah, definitely. So look, if you're this generally goes for self-employed clientele. I think taxes are due. I think it's the 15th of May, but a lot of people are carrying tax debts for whatever reason from previous financial years. So when there is outstanding tax debt, a lot of the time the bank will require you to clear that outstanding debt. You are allowed to, of course, owe your tax from the previous financial year if it is not yet due. like I've said, I think we've got till the 15th of May. But if there is overdue tax, yeah, that's even if everything stacks up with your loan and your loan application, if you've got outstanding tax debt, the bank is well within their right and inclined to require you to clear that tax debt.
Is that
You
a new
can,
thing?
no, it's not a new thing. I mean,
Okay.
you can you can get around it with a payment plan, like you get your accountant to draw up an agreed upon payment plan with the ATO, and that might sit outside of your credit assessment, but more likely it will sit in as part of your credit assessment in terms of your capacity. Um, so, I mean, but a lot of people are just looking to consolidate that tax debt
Mm,
into whatever loans they're looking to acquire,
mm,
and that's not unusual to consolidate tax debt now as well. So,
yeah. Oh, that's good. Government's raising a ban now for 2 years on foreign buyers. Do you see that impacting much in terms of the lending space? Do you get many foreign buyers coming in?
yeah, we get foreign buyers, but I don't see this creating much impact at all. Um, Look, personally, I don't do a whole lot of lending in this space for new new residents, or look, we do non-resident lending and whatnot, but it's not a huge chunk of what we do.
Mm.
Um, so yeah, I don't see this having a huge effect, to be honest.
I'm also just going to push them into the rental market anyway, soak up more of the rental stock. Another one is help to buy scheme. New scheme the government's bringing in, they're going to pay up to 30% for established and 40% for new. How does this work from your perspective?
Well, first of all, I don't do these loans. Brokers don't do these loans. These loans are offered direct. I think the only lender doing them is Bendigo Bank. I'm certainly not an expert on the help to buy um, loans. As I said, brokers don't do them. I think the whole concept sounds ridiculous to me. It sounds very socialist, communist. The idea of buying the property and co-owned with the government. I think there's better schemes available. Um, there's the government's first home buyer guarantee scheme that's been around for must be at least 4 or 5 years, probably 5 or 6 years. That is where you can go in with as little as a 5% deposit, and the government has no ownership in the property, but they will guarantee the loan so that you do not, as the borrower, you do not have to pay an LMI fee or higher rates when you borrow above that 80% threshold. You can borrow up to 95% of the property. This is for first home buyers looking to, yeah, first home buyers looking to buy a property to live in. It's not for investors. Um, and look, there are price caps and income thresholds that you do need to meet to get to be approved to that scheme. But at least that scheme, you are the sole owner on title, the sole loan holder. You are not co-owning with the government. Um, so I've done a stack of those loans over the last 5 years. It's been from what I can see, a somewhat effective scheme for first home buyers.
So if the first home buyer can't meet their debt obligations, what the government takes on the asset, does it? If they're guaranteeing the
No,
loan, how does it work?
no. So look, when normally without that scheme, if a buyer, whether they're first home buyer or not, if someone wants to buy property and borrow above 80% of the value of the property, they will
Mm,
be charged an LMI fee, lender's mortgage insurance fee, and they'll be charged higher rates, like as a premium for borrowing at a highly leveraged position. Now, the LMI fee, the lender's mortgage insurance fee, is just a fee that the lender's insurer charges the bank, and the bank passes that fee on to the borrower. So, I mean, there's really two main players. There's Helia and QBE that are the main mortgage insurers. You might have seen Helia is in a bit of trouble lately. They've just they've lost a lot of market share. I think they've just lost CBA as their who forms the majority of their business, and CBA's pulled out of their agreement with Helia after a long time. Helia used to be known as Genworth. Um, and so, funnily enough, the federal government, that first home buyer guarantee, by guaranteeing a lot of these loans for first home buyers, has actually taken a lot of business off the table for the mortgage insurers, Helia and QBE. So that is what would normally happen without the guarantee. The mortgage insurers charge the bank for lending at a highly leveraged position. It's just a risk fee, and the bank passes that fee onto the borrower.
Mm.
And so,
That's-
look, sorry, in answer to your question, like when anyone defaults or can't make their repayments, the bank will just take security of the property.
mm, yeah. But what is the government guaranteeing? If they
Well,
don't
the
have the
guarantee, so
mortgage, the insurance company would typically pay out the bank the difference if they have to
so
sell it, right?
the government's guaranteeing the loan so that the lender doesn't get charged the LMI fee, and
Right,
hence the borrower doesn't get charged the LMI fee.
right. Okay.
So, yeah.
I was going to bring up some stats, some data from ABS now. I just want to get your take on it. Can you see that now? Give it a sec.
Yes, I can.
So this is number of new loan commitments for dwellings, seasonally adjusted for Australia. It's starting to trend up. Trough in 23, hasn't surpassed the peak of that 2021 credit boom, but it's on the way.
Getting close, though, isn't it?
And I thought it even more interesting was the value of new commitments is almost hitting all-time high again, 80, 88 billion. Do you feel we are, I guess, on the cusp of another credit boom?
Well, firstly, just on that graph, the fact that the new loan commitments, the value of new loan commitments is almost equal to that boom time 2020, 2021 is incredible because, as you know, rates are now 6%, but you go back then, the rates were 2%. So people were borrowing more, people were borrowing as much as they could. Why wouldn't you? Rates are 2%. And so the fact that the value of new loan commitments is almost on par with that, while rates are at 6% or thereabouts, is that's astonishing to me. That says to me there's a lot of there's confidence. And back to what we were talking about before in terms of sentiment, like the expectation that rates have topped out and are potentially on a downward trend is all the confidence that people need to take on a large amount of debt.
Mm.
So that's what that says to me. Into your question about, sorry, what was the question? Are we about to have a boom in terms of lending?
Yeah, I mean, can you taking back to what the landscape was like in that 2020, 2021, when it was like a bit of a frenzy. Everyone was, this prior, 2020, 2021, we had a bit of a slowdown in 2022, but then it's starting to pick up again. I can feel it from more of a inquiries and from the buyer's agent perspective of where, people are at in terms of looking to buy, but more so from your perspective, people looking to get loans. What's it like now compared to in 2020, 2021? Similar?
Well, it's not the same in terms of the frenzy that was 2020 and 2021. The market was just moving so fast. And you would remember it. It was like there was serious FOMO in the
Mm,
market. Like you've got to get loan approved to buy something because you miss out, you come back a month later, that property has gone up again.
Yeah.
In terms of the clear trend towards more loans and higher value of new loans, I'll just say that is off the back of that dip that you see from back end of 22 into 23. That's just pent up buyer demand in terms of a lot of people sat it out for 12 months, 18 months while the real estate market corrected, came back down, while people got used to higher rates. And then I think we're just seeing a lot of people accepting that rates are going to be higher for longer, as the RBA would say. The new norm for rates is probably around about 5% a 3 to 4% cash rate. And that's acceptable. So I think it's just pent up buyer demand, I think. In terms of what that looks like at a real estate in the real estate setting, in terms of at an auction or trying to buy a property, you ask any real estate agent, there's a lot of buyers out there, but there isn't quite yet that frenzy FOMO to get a place. People are being more choosy, more picky, which is fine, but the markers are there that there are more and more people getting ready to buy. So look, it could be another case of another rate cut or two or three, and we could see a real kick in the market again for real estate.
Very good. I'll leave it there. I'll put Steve's details in the comments below. Steve has been a fantastic help to not only me, but my clients in the recent years when most mortgage brokers said you can't borrow anymore. Steve and Shore Financial have been able to definitely keep myself and my clients moving forward. So I can't thank Steve and the team enough. Thanks for jumping online, Steve. I'll be sure to drag you on again sometime soon. Thanks,
Look
mate.
forward to it.